Hi, quick question. Where is your money right now?
Most people think it's sitting safely in a vault at their bank. It isn't.
Your bank takes your deposit and immediately lends most of it out to other people.
And that act of lending, that's how brand new money gets created. Not by printing, by lending. This system has a name. It's called fractional reserve banking, and it runs the entire world economy. Let me show you exactly how it works with a simple example. You deposit $1,000 at your bank. The bank keeps a small fraction as reserves, say 10%. That's $100. The other $900? Gone, lent out. That $900 loan goes to someone, say a small business owner. She spends it. The contractor she paid deposits it in another bank. That second bank keeps 10% and lends out $810. That $810 gets spent, deposited, and lent out again. This cycle repeats over and over. Your original $1,000 deposit can turn into up to $9,000 of new money in the economy. The physical cash never changed. Only 1,000 real dollars exist, but the economy is now acting as if 9,000 do. This is called the money multiplier effect. Banks don't print money, they multiply it through lending. Here's the thing nobody tells you. In the US, since March 2020, the reserve requirement is exactly 0%. That means technically, banks aren't required to keep any of your deposit as reserves. Zero. Nothing. So, what stops banks from creating infinite money? Three things: capital rules, interest rates, and borrower demand. Capital rules force banks to hold their own money as a safety cushion. If loans go bad, the bank absorbs the loss, not you. Interest rates control appetite. When the Federal Reserve raises rates, loans become expensive. Less borrowing means less new money gets created. And borrower demand. If nobody wants a loan, the bank can't create money, no matter how much they want to. This is actually why the 2008 QE didn't cause massive inflation. Banks got mountains of reserves, but nobody wanted to borrow. Now here's what happens when the system breaks: a bank run. You've seen the movies. It's very real. Everyone tries to withdraw at once, but the money isn't there. It's out as loans. The bank can't pay everyone back. This happened to Silicon Valley Bank in March 2023. Deposits fled overnight. The bank collapsed in 48 hours. But most of the time, the system works, because not everyone withdraws at once. That's the basic assumption the whole thing rests on. The central bank, the Federal Reserve, acts as a backstop. It can lend banks emergency reserves if a run starts. It's the safety net. And the Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. If your bank fails, the government pays you back up to that limit. So, is this system good or bad? Honestly, both. It fuels economic growth, but it also creates instability when trust breaks down. Every mortgage, every business loan, every student loan, they all created new money the moment the bank approved them.
And when those loans are paid back, that money disappears from the economy. Money is literally born and dies through borrowing. Now you understand something most people never figure out: banks don't just hold money. They create it. Every single.
And if this finally made sense, hit subscribe. I break down economics like this every single week. See you next time.